vpod.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged and VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Okay, so let's dive in. When you hear about those huge financial leaks, the Panama Papers, Pandora Papers, what immediately comes to mind for most people?
Probably complex schemes, right? Hidden money, shell companies, the super wealthy, kind of moving things around secretly.
Exactly. And those leaks, they really did give us this, unprecedented glimpse into that hidden financial world, didn't they?
They certainly did, shone a huge spotlight on offshore accounts, tax havens, all of that.
And that world, the one sort of thrust into the public eye, is what we're really getting into today. We've been looking through the details on everything from those offshore accounts themselves to the incredibly complex strategies that big multinational companies use, international tax planning.
Yeah, and the aim here is really to get past the headlines, the common idea that offshore just equals illegal. We want to understand the whole spectrum.
Right. What are these places, these structures? What's actually legal?
Where does it cross the line? And importantly, how are governments actually finding this stuff now? Then we could shift gears a bit.
To the corporate side.
Exactly. To look at the sophisticated, sometimes controversial, but often technically legal tax planning that global businesses engage in.
Because it's clearly not just some shady back alley thing. It's this massive, complex legal and financial system affecting individuals and huge corporations.
Yeah.
So, okay, let's start with the basics. Definitions.
Good idea. So tax havens and offshore accounts, what's the image? Palm trees, deserted islands.
Guilty. That's the cliche, isn't it? But the reality seems quite different. Places like Hong Kong, Guernsey, Jersey, Luxembourg, Isle of Man, these aren't exactly tropical backwaters.
Not at all. They're major financial centers. And the idea itself isn't even new. Apparently, there's evidence the ancient Greeks used certain islands for, things that sound a lot like early tax avoidance.
Wow. So it's less about the geography and more about what defines them, the characteristics.
That's right. If you look at how organizations like the OECD define them, it usually comes down to a few things. One, low or even zero tax on certain kinds of income.
Okay.
Two, really strict financial privacy laws. Makes it hard for outsiders like other governments to see what's going on.
And three.
Just a general lack of transparency about who owns what, where the money's coming from.
And it's tricky because they're not all identical, right?
Yeah.
One study mentioned how hard it is to pin down a single definition beyond, those low effective tax rates.
Exactly. The specifics vary quite a bit, which leads to the big question, given that picture of low tax and high privacy.
Is it actually legal just to have an account there?
And the answer is yes, absolutely. Despite the reputation from the leaks, having an offshore account can be perfectly fine, legitimate, even common for some people.
Like who, for instance?
Well, think about someone living overseas, an expat, or maybe someone with dual citizenship. They might just need a bank account in another country for practical reasons.
Okay.
As long as they declare any income earned on that account back home to their own tax authority. Perfectly legal.
Or maybe you own a business there, or a property.
Exactly. You own a rental property, say. You need somewhere to collect the rent. Again, totally fine if you declare that income back home.
And the interest, too, right? That seems key. Any interest earned on the money sitting in that account has to be declared.
That's a crucial point. It's often the interest or other investment income that people either forget or deliberately don't report.
So it really boils down to not where the account is, but what you do with it. And crucially, whether you're upfront about it with your own tax people.
Precisely.
Yeah.
And this is why professional advice is so important, because as you said, that line between doing something legitimate, even if it's complex, and doing something illegal, it can be easy to cross accidentally, let alone intentionally.
Okay, so let's talk about crossing that line. When does it stop being just, managing international finances and become illegal? Tax evasion.
It becomes illegal when the purpose of the offshore account is specifically to hide income or assets, to conceal things you are legally supposed to pay tax on in your home country. That's tax fraud.
Okay, so like the example given. If I could live in the UK, sell a property I owned in the Cayman Islands, make a profit. And I just don't tell the UK tax authorities, HMRC, about that profit because I don't want to pay capital gains tax. That's illegal.
That's the core of it, yes. And while that's a simple case, the real-world illegal stuff often involves incredibly complex layers.
Mm.
Shell companies, trusts, money moving through multiple countries.
Which is why governments dedicate so much effort to trying to track it all down.
It takes serious resources, absolutely.
So how are they getting better at finding this hidden money? It seems like a huge challenge.
It is, but they're relying more and more on intelligence, both domestic and, crucially, international cooperation. A really big development has been the Common Reporting Standard, the CRS.
Right, the automatic information sharing thing.
Exactly. Over 100 countries are part of it now. Their banks and financial institutions automatically send details about accounts held by foreign residents, balances, interest, dividends, sales proceeds, back to the account holder's home tax authority.
That sounds massive. I think I saw a figure about the UK getting info on like 9 million accounts.
Something like that, yeah. It's a huge amount of data flowing automatically between tax authorities. A real game changer compared to the old days of having to formally request information, which could take ages or get blocked.
Makes sense. It removes a lot of the hiding places.
It does, and it's not static. They're constantly updating the rules. Like, new rules for digital platforms just started this year, January 2024.
What do they do?
They make online marketplaces, platforms like that, report information about their sellers to tax authorities, trying to catch up with the gig economy and online sales.
And crypto's next.
Yep. The Crypto Asset Reporting Framework, CARF, is on its way. Set to start collecting data in 2026, exchanging it in 2027. It's designed to bring crypto assets into a similar automatic reporting system, closing a gap in the CRS.
So the global net is definitely tightening.
It is, and countries are doing things domestically, too. The UK examples mentioned were the people with significant control register.
Which shows who really owns companies.
Right, and the Register of Overseas Entities brought in fairly recently, 2022, I think. That focuses on revealing the beneficial owners of UK property held through offshore structures. It's all about increasing visibility.
Okay, so we've got offshore accounts, legal versus illegal use, and how governments are using data sharing to fight evasion. But you said earlier, that's only one part of the story. The really complex stuff is this international tax planning.
Right, let's shift gears. Now we're talking less about individuals hiding personal wealth and more about how multinational corporations structure their global operations. It's described as a multifaceted discipline focused on the lawful arrangement of cross-border business.
Okay, lawful being the key word there. Different from the evasion we just discussed.
Totally different. The goal here is to use the existing laws in different countries and the tax treaties between them to legally minimize the company's overall tax burden, maximize net income within the rules.
But there's also this term, aggressive international tax planning.
Yes. And that's where it gets more controversial. Aggressive planning is defined more as exploiting technicalities, loopholes, or mismatches between different countries' tax systems, specifically to reduce tax, sometimes in ways that weren't really intended by the lawmakers.
So just to be clear for everyone listening, we're now talking about techniques that are either within the law or perhaps pushing the boundaries using technical arguments, but not the illegal hiding of income like before.
Exactly. No outright evasion here. So why do companies do this lawful planning? Well, often it's to avoid double taxation, being taxed on the same profit in two different countries.
Fair enough.
Or to use legitimate deductions or allowances provided in tax law, like for depreciation. Sometimes it's about managing tax efficiently during major business deals, like acquisitions or disposals. And frankly, it's about maintaining a competitive, effective tax rate, their ETR, compared to other global companies.
So it's kind of like individuals finding legal ways to reduce their tax bill, just on a massive global scale.
A much, much more complex scale, yes. Using things like specific corporate structures, holding companies, managing withholding taxes, setting transfer prices.
Transfer prices. That's how different parts of the same company charge each other for goods or services across borders, right?
Exactly. And also structuring financing, locating intellectual property strategically. It's a huge field.
And these aggressive tax planning models you mentioned, are these specific schemes?
They're more like patterns or concepts that tax authorities look for as indicators of potential risk, ways that companies might be exploiting those loopholes or mismatches we talked about. Let's look at a couple. Hybrid financing is one.
Okay, sounds technical. What's the basic idea?
The basic idea is clever, really. You exploit a situation where two countries define the same financial payment differently.
How so?
Well, imagine a payment from Company A in Country 1 to its related Company B in Country 2. Country 1 might see that payment as, say, tax-deductible interest on a loan. But country 2, where company B receives it, might classify it differently, maybe as a type of dividend or equity return that isn't taxed in their system.
Ah, so company A gets a tax deduction in country 1.
But company B doesn't pay tax on that same money when it arrives in country 2.
That's the deduction inclusion outcome they talk about.
Exactly. One side gets a deduction, the other side doesn't count it as taxable income. It hinges on those differences in legal definitions between countries.
Okay, I think I get the concept. What about the interest-free loan or debt pushdown? That sounds a bit more straightforward.
It is, conceptually. This involves using loans within the multinational group. Often, the strategy is to load up a subsidiary in a high-tax country with debt owed to another group company, perhaps one in a low-tax country.
And the goal there is,
Interest payments on debt are usually tax-deductible. So the subsidiary in the high-tax country makes these large interest payments to the other group company.
producing its taxable profit in that high-tax country.
Precisely. It effectively shifts taxable profit via the interest deduction from the high-tax location to the lower-tax location where the interest is received.
It's moving the deduction to where it saves the most tax.
Essentially, yes. Though there are rules around this, like the arm's length principle, the interest rate and terms should be similar to what unrelated parties would agree to. And things like currency fluctuations can add another layer of risk or complexity, too.
And the third example, the patent box, or IP structures. That sounds like it's about intellectual property.
It is. This is very common. Many countries want to attract high-value activity, so they offer special low tax rates on income derived from intellectual property patents, sometimes trademarks, software, know-how. These regimes are often called patent boxes.
So companies just move their patents there.
They often structure it so that the legal ownership of valuable IP sits in a group company located in a jurisdiction with a favorable patent box. Then, the group's operating companies around the world, the ones actually selling products or services using that IP.
They pay royalties to the IP holding company.
Exactly. Those royalty payments are typically tax-deductible expenses for the operating companies in, say, higher tax countries. This shifts profit related to the IP into the low-tax patent box jurisdiction.
So the profit attributed to the brand or the technology ends up being taxed at the lower rate.
That's the aim, separating where the IP is legally held for tax purposes from where the sales actually occur.
So when tax authorities are looking at these kinds of structures, what flags them as potentially aggressive? What are the warning signs?
Well, they look for combinations of features in different jurisdictions that enable these outcomes. Things like a country not taxing dividends received from foreign subsidiaries at all, or maybe a lack of effective controlled foreign company rules.
Those are the rules meant to stop companies just parking profits offshore indefinitely.
Right. Other indicators could be no withholding tax charged when things like royalties or interest payments leave the country, the existence of those very generous patent boxes or other preferential regimes, or maybe a lack of specific rules to counteract those hybrid mismatches we discussed earlier.
Basically, they're looking for structures that seem primarily designed to make income disappear from the tax base or shift it somewhere it barely gets taxed using features of the tax system itself.
That's a good way to put it. It's this constant cat and mouse game, almost. Planners find techniques, authorities try to close them down.
And it feels like the whole landscape is shifting now, doesn't it? Towards more scrutiny.
Definitely. We're in this, era of globalization, but that also means more attention. Those leaks fueled public interest and anger. There's more media focus, the whole naming and shaming thing. Plus, NGOs and activists are really pushing for change.
And it seems to be driving this global conversation about fairness. What's a fair share of tax for a huge multinational company?
Exactly. And governments are responding. You see tighter domestic laws in many countries.
And those big international projects, too, BEPS.
Yes, BEPS, base erosion and profit shifting. That's a major OECD G20 initiative aimed directly at many of these aggressive planning techniques. And the EU has its own anti-tax avoidance package doing similar things. It's a coordinated pushback.
So what does this mean for companies? How are they adapting?
Well, one major change is that tax is moving up the agenda. It's not just siloed in the finance or tax department anymore. It's becoming a boardroom issue.
Because the reputational risk is higher.
That's a big part of it. Historically, maybe a company just complied with the letter of the law and didn't say much publicly, or had a very vague statement somewhere.
But now, especially for consumer-facing brands like those examples mentioned, Vodafone, Starbucks, They face real public pressure.
Exactly. So we're seeing a trend towards companies developing much more detailed, explicit tax policies and strategies, and trying to align them with their overall corporate responsibility goals.
But not everyone's there yet.
No, it seems many still lag. Maybe because there aren't always mandatory corporate governance rules requiring these detailed public policies, or, interestingly, maybe internal incentives get in the way.
How so?
If bonus schemes are tied purely to pre-tax profit figures, for example, there might be less internal drive to focus on the tax strategy itself. The material called it focusing on the wrong P&L lines.
That's fascinating. Internal metrics potentially working against a strategic approach to tax.
Yeah, it highlights why good communication about tax strategy is vital, both internally, so everyone's on the same page, and externally to explain the company's approach to stakeholders.
So it's moving beyond just compliance towards having a clear, practical internal roadmap. Like, these are the things we do, these are the things we don't do.
Absolutely. And making sure that strategy isn't just owned by the tax team. It needs buy-in from finance, accounting, senior management, the board, even the audit committee. It has to be embedded across the organization.
So it's this dynamic situation. Governments are pushing for transparency, closing loopholes. Companies are developing more complex strategies, facing more scrutiny.
It's a real balancing act for them.
Which kind of leaves us with a final thought, doesn't it? Something for you, the listener, to think about. As these global efforts continue pushing for more transparency and challenging aggressive tax planning, how will these huge multinational companies navigate that tension? How will they balance the legal duty to, maximize shareholder value with this growing pressure from the public, from governments for what's perceived as fairness, in where global profits actually end up getting taxed?
That's the big question going forward.
vpod.ai, your source for information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyper-converged and VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com.